What if an ordinary transaction at your bank isn't ordinary at all? A cash deposit, a wire transfer, or a new account can sometimes be one piece of a much larger financial crime. That's why BSA and AML Compliance matters. In this bootcamp, we're going to break down the Bank Secrecy Act and Anti-Money Laundering compliance in a way that connects the regulations to what actually happens inside a financial institution. We're going to learn how to detect suspicious activity, investigate the facts, report when required, and protect the institution. Throughout this training, remember 3 things: recognize the risk, follow the money, protect the institution. Let's get into it. First, here's exactly what you're going to learn. By the end of this BSA and AML training, I want you to be able to do more than define compliance terms. I want you to know what to do with them. We'll start by understanding the BSA and AML framework and the organizations responsible for protecting the financial system. Then, we'll identify customer risks and reporting requirements, recognize common money laundering red flags, and learn when something needs to be escalated. Finally, we'll put everything together in a realistic banking scenario. The goal isn't memorization. The goal is being able to recognize when something doesn't look right and knowing what comes next. But before we talk about rules, we need to understand why these rules exist. BSA and AML compliance isn't just paperwork. At its core, it's about stopping the financial system from being used to move or disguise illicit money. Think about what happens when financial institutions collect customer information, monitor activity, and file accurate reports. Individual transactions begin creating financial intelligence. That intelligence can help identify money laundering, fraud, terrorist financing, sanctions evasion, and other illicit activity. So, compliance has 3 major outcomes: detect illicit finance, create useful financial intelligence, and protect the financial system. And here's the part that matters to every banker watching this. You may be the first person who notices that something doesn't make sense. So how does a normal customer transaction become a compliance concern? Follow the money. This is one of the most important frameworks in the entire course. Start with the customer. Who are they, and have we properly identified them? Next comes the profile. Why does this customer have the account? What products do they use? What activity should we reasonably expect? Then come the transactions. We're comparing what the customer is actually doing against what we understand about that customer. When something falls outside the expected pattern, it may generate an alert. But an alert isn't proof of money laundering. It's a signal that says, look closer. That leads to investigation, reviewing transactions, documents, history, and context. Then comes the decision. Document the findings, escalate appropriately, and file any required report. That's the life cycle. Know the customer, understand the profile, monitor the activity, investigate the unusual, make the right decision. And your institution isn't doing this alone. BSA and AML compliance is an ecosystem. At the center of the federal BSA framework is FinCEN, the Financial Crimes Enforcement Network, a bureau of the United States Treasury. FinCEN administers the BSA framework, receives BSA reporting, and uses financial intelligence to combat illicit finance. Then there's OFAC, the Office of Foreign Assets Control. OFAC administers United States economic and trade sanctions. Sanctions compliance is related to financial crime compliance, but don't confuse an OFAC obligation with a SAR or CTR requirement. Federal banking regulators, including the OCC, Federal Reserve, FDIC, and NCUA within their respective jurisdictions, supervise and examine institutions for BSA and AML compliance. And then there's your institution. Policies and technology matter, but ultimately, people make the system work. So what does an effective BSA and AML program look like inside the institution? Think of a BSA and AML program like a structure. If one major support fails, the entire program becomes weaker. First are risk-based policies, procedures, and internal controls. Controls should make sense for the institution's actual customers, products, services, geographies, and risk. Second is a designated BSA compliance officer with the authority and resources to oversee the program. Third is independent testing. Someone has to objectively evaluate whether the program is actually working. And fourth is training for appropriate personnel. Board and management oversight support the entire framework by setting expectations, providing resources, and holding the program accountable. The important word here is risk-based. A community bank, a global bank, and a fintech company don't necessarily have identical risks. Effective BSA and AML compliance has to understand the institution it is protecting. Now let's look at the controls employees encounter in everyday banking. This is where the pieces start connecting. CIP, or the Customer Identification Program, helps establish who the customer is. CDD, or Customer Due Diligence, goes deeper. What's the nature and purpose of the relationship, and what risk does it present? Beneficial ownership requirements help covered institutions understand the natural persons behind applicable legal entity customers. Then we have ongoing monitoring, suspicious activity reporting, currency transaction reporting, information sharing, record keeping, risk assessment, and independent testing. Don't think of these as isolated compliance boxes. They're connected. Customer information gives context to transactions. Monitoring identifies activity that may not fit that context. Investigation adds facts. Reporting communicates information when the applicable requirements are met. That's how separate controls become a compliance system. And two reports you'll hear about constantly in BSA training are the SAR and the CTR. SAR and CTR are sometimes discussed together, but they answer two very different questions. A CTR, or Currency Transaction Report, is generally triggered when currency transactions exceed $10,000 in a single business day, subject to applicable aggregation and exemption rules. A SAR, or Suspicious Activity Report, is about suspicious activity and the applicable SAR rules, including regulatory thresholds that can depend on the type of institution and circumstances. Here's the easiest way to remember the distinction. CTR asks about currency and amount. SAR asks about suspicious activity, and the two aren't mutually exclusive. Activity can create a CTR obligation and also warrant review for possible suspicious activity reporting. One more critical rule: SAR information is confidential. Employees should never tell a customer that a SAR has been filed or is being considered. Now let's move from transactions to something equally important: understanding who's actually behind a legal entity customer. A company name doesn't always tell you who actually owns or controls the business. That's why beneficial ownership matters. Under FinCEN's Customer Due Diligence Framework for covered financial institutions, the ownership prong generally looks to individuals owning 25% or more of the equity interests of an applicable legal entity customer, along with the applicable control prong. The institution identifies the required beneficial owners, verifies identity according to its procedures, documents the information, and uses that information as part of customer due diligence. There's also an important 2026 update. FinCEN granted relief from having to repeat beneficial owner identification and verification every time an existing legal entity customer opens another account, subject to the conditions of that relief and the institution's procedures. And don't confuse a bank's customer due diligence obligations with the separate Corporate Transparency Act beneficial ownership information reporting regime. That distinction becomes especially important in 2026. Because BSA and AML compliance isn't static. The rules and regulatory priorities continue to evolve. This is why good compliance professionals never stop learning. In April 2026, FinCEN proposed major changes designed to modernize financial institutions, AML and CFT programs, and place greater emphasis on effectiveness and risk-based decision-making. But remember the word propose. As of this training, that proposal is not a final rule. Beneficial ownership reporting under the Corporate Transparency Act has also changed significantly. FinCEN's August 2026 final rule exempts United States companies from beneficial ownership information reporting. Certain foreign companies registered to do business in the United States remain within the reporting framework, while United States persons receive additional relief. Financial institutions also continue adapting to evolving risks involving digital assets and stablecoins. The lesson isn't to chase headlines, it's to build a compliance culture that can adapt when the rules and risks change. Now let's put the regulations aside for a moment and talk about what you may actually see. Money laundering usually doesn't walk into a bank wearing a sign that says money laundering. You recognize it through patterns. Maybe a customer repeatedly breaks cash activity into smaller transactions. Maybe money moves rapidly through an account without an obvious business purpose. Maybe there are unexplained third-party payments, multiple accounts being used in unusual ways, inconsistent information, high-risk geographic exposure, or reluctance to answer reasonable questions. These are red flags, but a red flag is not proof that a crime occurred. Context matters. One unusual transaction may have a reasonable explanation. Multiple connected red flags can tell a very different story. Your job is not to accuse. Your job is to recognize, document, and escalate. Let's see what that looks like with a customer standing in front of us. Imagine this. A customer repeatedly deposits cash just below $10,000 at different branches. When employees ask routine questions about the source of the funds, the customer becomes evasive. What do you notice? The dollar amounts alone don't prove anything. But now combine the pattern. Repeated deposits, amounts positioned below the CTR threshold, multiple branches, and reluctance to explain the source of funds. That combination can indicate structuring, which is breaking transactions apart in an attempt to evade BSA reporting requirements. So, what should the employee do? Ask appropriate questions consistent with policy. Document the facts. Look for additional red flags. And escalate through the institution's BSA and AML process. Do not tell the customer, "I think you're structuring." We deal in facts, not accusations. Once an investigation reaches a reporting decision, timing and confidentiality become critical. Let's lock in 2 reporting timelines. For a CTR, the filing deadline is generally 15 calendar days after the reportable transaction. And remember, the CTR trigger is generally more than $10,000 in currency in 1 business day after applying the appropriate aggregation rules. For a bank SAR, the general filing deadline is 30 calendar days after initial detection of facts that may constitute a basis for filing, with additional rules for situations where no suspect can initially be identified. SAR confidentiality is critical. Employees must not disclose to the customer that a SAR was filed or may be filed. Records and supporting documentation also have retention requirements, including a 5-year SAR retention period. Compliance isn't finished when you recognize the activity. Reporting accurately, on time, and confidentially is part of the control. Now it's your turn. Let's see what you remember. Don't just listen. Test yourself. Question 1. What generally triggers a CTR? Think currency exceeding $10,000 in 1 business day after applying the relevant aggregation and exemption rules. Question 2. What triggers a SAR? Suspicious activity that meets the applicable reporting requirements, not simply a large dollar amount. Question 3. How long are SAR records generally retained? 5 years from the filing date. And question 4. Who is responsible for BSA and AML compliance? The institution has formal compliance responsibilities and designated roles, but an effective program depends on employees carrying out the controls assigned to them. If you work on the front line, in operations, lending, compliance, fraud, management, or another function, you can be part of the detection system. And that brings us back to where we started. You've completed the J Get It BSA and AML Compliance Bootcamp, but I want you to leave with something more useful than a list of acronyms. Remember the process. Know it. Check it. Report it. Protect it. Know your customer and your institution's procedures. Check the activity against what makes sense. Report and escalate concerns through the proper channels, and protect the customer, the institution, and the financial system. If this BSA and AML training helped make concepts like SARs, CTRs, beneficial ownership, customer due diligence, structuring, and money laundering red flags easier to understand, subscribe to J Get It for more practical banking and financial services training. And remember, recognize the risk, follow the money, protect the institution. I'll see you in the next training. Disclaimer: this content is for educational purposes only and is not financial, legal, or investment advice. Please consult a qualified professional before making any financial decisions.